Welcome to another Credent Connect series. And this week, we're going to focus on the debt ceiling, right? Very exciting debate and discussion on the U.S. debt ceiling and just debt in general surrounding the national government. And why this is important, first of all, we're not going to be having a political discussion. That's not part of the reasoning to have this overview. But we do want to look at the objective nature of what's happening, why it's happening, and potential outcomes, both from a control and a no control from an investor standpoint. So let's kick it off, Alisha, and just give us a quick overview. What's happening right now? It is all over the media. Political parties on both sides are debating, sometimes arguing. What's happening?
The U.S. government hit the debt ceiling in January of 2023, and so our debt limit is $31.4 trillion. And so since then, Treasury Secretary Yellen has been doing some accounting maneuvers to continue to meet the U.S.'s obligations. And so she has last week said that she can run out of ample ability to hit the obligations by June 1st, which is actually a little bit earlier than what the market was expecting. And so now what's going on is that Congress needs to meet, and they need to come up with a compromise in order to either extend the debt limit or get rid of it altogether.
Yeah, and there's been a lot of media coverage on the notion of what will happen if we don't extend the debt ceiling, right? If we don't raise the debt ceiling. I want to just stress the fact that nobody knows definitively what will happen on that front. We can certainly extrapolate. We know there's likely to be volatility across various segments of the markets short term, but to say definitively what will happen and to assume that the government is not going to do this by raising it, that's a little premature. Do we have any historical context of this? If it's happened before in terms of not raising the debt ceiling, capital market reactions, things of that nature?
Yeah, so we've actually had 3 instances recently about debt ceiling impasses, and that happened in 2011, 2013, and again in 2021. And so 2 things that we can really take away from what happened during that time period is that there was volatility within the Treasury market as well as volatility within equities. And so what we're looking at now is we're seeing that Treasuries that are due around this X date of early June into July and August, we're seeing higher yields. And so we can think of those as risk premium for holding that debt that matures close to that debt ceiling. Second, we can look at volatility in the markets over those cycles. And what we saw is as the X date approaches, volatility tends to increase.
Got it. So to add one thing to that, the notion of the possibility for volatility around this topic. There are things in the market that investors can trade. They're called credit default swaps, right? They say, okay, I'm willing to pay you, but if something fails, I want you to pay me back at X amount. The probability as of right now that the United States defaults on its debt, right? Technical default, and kind of what that would mean is, the Treasury will stop paying interest in the short term and things of that nature. That probability stands at less than around 4% as of right now. So less than 4% probability in aggregate, being so close to the June 1st deadline you just talked about. We are going to, again, be very cautious in trying to extrapolate the risks here of what it may happen or what would happen under that scenario. It is too premature. It is entirely media-driven with no real basis behind it. On that note, Alisha, what can investors do, or what should they do, and what are we doing in this context for our clients amidst this perceived turmoil, so to speak?
So what we're really trying to do is urge our investors to focus on things that they can control, because this is something, a tail risk that you spoke of, that we cannot control. And so, what can investors do about this? Well, they can take a long-term focus. We really don't want investors to take a short-term focus and bail out of equity market participation. So take your long-term focus, maintain equity market participation, and even take advantage of dislocations in the market as they occur. And most importantly, we urge investors to stick to their long-term plan. Work with your financial advisor if you have any questions on this, but really making rash decisions in this sort of environment is not going to work out for you long-term.
Yeah. Prior to recording this, we had a discussion about the August 2011 volatility cycle. We both vividly remember kind of that immense downside that happened in just 1 month before it completely recovered post the fact. And that was when the U.S. credit rating was downgraded because of similar discussions. All that's to say is that in the short term, there is certainly room for rash decision making, right? The ability to not make that decision is where guidance really comes in, the advising really comes in, and we urge investors to forego that really loud short-term noise around this debt ceiling component. We will be releasing this research piece out, so please be on the lookout for that. And I want to leave you today with one last bullet point on kind of the debt ceiling and debt in general. One of the benefits of the United States currency, the US dollar, is that it is a global reserve currency. The beauty of that is that it allows a lot of benefits for U.S. consumers, businesses, and even for the government along those lines. The reality of what's happening today is that in order for the world to be supplied with U.S. dollars, there always has to be a certain level of debt that the U.S. government has. Now, the extent of that debt can certainly be managed, but to be debt-free in any capacity or to have low levels of debt while simultaneously having a global reserve currency, those two things cannot happen simultaneously. So to say that debt ceiling cannot be raised is also an indirect argument of allowing other global currencies to potentially overtake the dollar in the long term as that main reserve currency. Certainly not something the U.S. government wants, certainly not something that we are planning on, and we think all those discussion topics have been and are being discussed daily, if not multiple times throughout the day, with our leadership in Washington. Thank you.